Ah, the late 1990s. Remember that? The sound of a dial-up modem, the dot-com boom, and this wild feeling that anybody, and I mean anybody, could get rich on the stock market, like overnight. It was pure financial euphoria. And today, we are diving straight into the madness of that time through the lens of Benjamin Graham's classic, The Intelligent Investor.
I mean, this was the vibe. You'd see commercials with regular people just making a month's salary with a few clicks of a mouse. The stock market stopped being about careful analysis and business fundamentals. It turned into this national video game where it felt like everyone had the cheat codes. Investing was supposed to be effortless, instant, a sure thing.
And that's the classic trap, isn't it? When every stock you pick goes up, it's so easy to believe you're some kind of financial prodigy. But it was all an illusion. The rising tide was lifting all the boats, even the ones full of holes. And this false sense of invincibility was about to get a serious reality check.
So first, let's just soak in the seductive sound of that bull market and see how it convinced millions of people that they just could not lose. The signs of pure mania were just everywhere. You had celebrities like Barbra Streisand admitting her entire investment strategy was based on not liking the color red. Seriously. You had fund managers making these completely absurd predictions. 50% gains every year for 2 decades. And then you had millions of regular people day trading, totally convinced they were smarter than all the experts.
And this really gets to the core of the problem. There was so much information, constant financial news, websites pouring out stock quotes, but it didn't create any real wisdom. Stocks got totally disconnected from the actual businesses they represented. They just became these little abstract blips on a screen, and as long as that blip was moving up, well, nothing else mattered.
So what happens when an entire market is built on hype instead of actual value? Well, the so-called sure things get exposed, and the whole house of cards comes crashing down. This number right here, represents the absolute screaming peak of absurdity. That is the one-day gain of a company called VA Linux on its very first day of trading. The demand was so insane that the stock shot up from an initial price of $30 to nearly $300 in a few hours.
And what happened next was, well, completely inevitable. That rocket ship ran out of fuel, hard. Just 3 years later, that very same share of VA Linux was trading for about $1.19. It didn't just fall, as the book so perfectly puts it, it came down like a buttered brick, a total, devastating collapse.
The era was just full of these bizarre mechanical systems that promised to crush the market. Take a look at this one. It was hugely popular, called the Foolish Four. It reads like some kind of secret code, right? But the rules are completely arbitrary. There's no analysis of the business, no thought about the future. It's just data mining, mistaking random patterns for some kind of genius strategy.
So how'd it do? Here are the results. In the year 2000, this supposedly foolproof system didn't just fail to beat the market, it got absolutely destroyed. It lost almost 3 times as much as the Dow Jones average. This is a perfect example of what Graham warned us about. What's popular is almost never what's intelligent.
Okay, so how do you actually escape all this madness? Well, this is where we turn to the incredible wisdom of our guide, Benjamin Graham, and his most powerful tool for staying sane in an insane world.
See, Graham wasn't just some theorist. He was a practitioner who learned his lessons the hard way. He lost nearly 70% of his money in the Great Crash of 1929. So his principles weren't born in a nice, cozy bull market. They were forged in the fire of a devastating crash. And they're all based on one simple idea. Think like you own the business, not like you're just gambling on a stock price.
Now, this is probably Graham's most famous idea. He tells us to imagine the market not as some all-knowing entity, but as this moody, totally irrational business partner. Some days, he's euphoric, he's on top of the world, and he'll offer you ridiculously high prices for your shares. But other days, he's terrified, convinced the world is ending, and he'll offer to sell you his shares for pennies on the dollar. And here's the crucial part. You are never obligated to trade with him. You don't have to sell just because he's wildly optimistic, and you definitely don't have to panic and sell just because he is. The intelligent investor's job is to use their partner's emotional swings to their advantage. You buy from him when he's pessimistic, and maybe you sell to him when he's euphoric.
And that leads us right to Graham's single most important principle. It's the one concept that really separates true investing from just pure gambling: the margin of safety. Look, the math of a big loss is just brutal.
Think about it. If you suffer one 50% loss, even if you make a solid 10% every single year after that, it'll still take you nearly 2 decades just to catch up to someone who just earned a steady, boring 5% the whole time. A huge loss digs a hole so deep it can be almost impossible to climb out of.
This is why legendary financiers like J.K. Klingenstein could sum up their entire philosophy in just 2 words: don't lose. It's not about chasing the highest possible returns. It's about avoiding those catastrophic, game-ending losses. That right there is the heart of having a margin of safety.
And if you need one more number to really drive this point home, here it is: 1,900%. That is the gain you need just to break even after you suffer a 95% loss, which is exactly where many of those .com investors found themselves. A return like that is basically impossible to achieve. The best way to win is to just not lose big in the first place.
So this brings us to the final, and I think the most profound, lesson from Graham's entire philosophy. Turns out the greatest danger in the market isn't a crash or a bad stock pick. No, it's something much, much closer to home.
It is not about being the smartest person in the room. Graham saw people with genius-level IQs who were just awful investors. Why? Because they couldn't control their own emotions. Real success comes from your ability to resist the pull of Mr. Market's moods, to stay disciplined and rational when everyone around you is either panicking or popping champagne.
So I'll just leave you with this question. After everything we've looked at, the bubbles, the crashes, the foolish formulas, where does the real risk actually come from?
And the answer is pretty profound. The biggest risk isn't in your portfolio. It's you. It's the person staring back at you in the mirror. Your behavior, your discipline, your temperament, that is the final boss you have to conquer, become a truly intelligent investor.